Hiya, this is Thinking Solo. I'm Ryan DeRusso, a fee-only financial planner. Today I want to take you through what tax planning looks like. While I cannot provide an entire picture, I can show you how we approach the process and sort of what it looks like in those conversations when we are doing tax planning with a client. In this video, you'll see a mock client, and then I'll discuss one strategy that this client can use to drastically reduce their taxes. It's not everything, but it's a look at one move they can make to reduce the amount they give to Uncle Sam, increasing the amount they can reinvest in their business, their family, or themselves. So, as we run through an example, first we need to figure out who we are helping because so much of the advice is going to depend on the individual or family group. And so, for this example, I've just created a typical person who may come through the door. So, you have someone who's 45 and they're a private practice therapist. They are married to someone who is 43, and that person works for an organization, and they have two children. One is 13 and one is 8. And so from there, we would take a look at the income coming in. And so the spouse who works for an employee makes $80,000 a year, and the person who's runs the private practice makes about $150,000 a year. They currently spend about $8,000 a month. In terms of savings, they have the private practice therapist has a solo 401k that they put about $2,000 in. The spouse puts about 10%. They have a pretty traditional match of up to 3%, and then they put $3,000 into an IRA. And then you also have from 529 savings. They contribute $1,000 to each child's college education. Now for their goals, they want to retire by 67. They want retirement expenses to stay at their current levels, inflationarily adjusted for inflation. We've added health costs, long-term care costs. They also have, they would like to pay for at least some of the child's education, and the private practice practitioner, has been doing pretty well. Wants to get a $50,000 car in the next year or so, and then they go on a family vacation of about $3,000 per year. The only other thing is in the net worth, we would include any bank accounts, joint and personal, any credit card debt, any other debts, the investments, as well as any loans that are out, whether it's a mortgage, another business loan, maybe the current price of the property, and any other sources of income. When a client comes to us, one of the things that we take a very proactive approach on is what exactly, from a tax perspective, is the person doing, and how can we adjust that to make sure that they're keeping more of their money and using that money to fund other goals. It's a big part of the process, and one that often people overlook or don't understand with reasonable reasons for the fact that most people don't want to understand the full complexity of the tax law. And so that's really where we come in. So in the scenario where we have a private practice therapist making $150,000, currently let's say they have a sole proprietor or maybe an LLC. So what we need to do is figure out, is that the proper tax structure for them? Business structure from a tax perspective. And so with that, we see this is the current situation. If you look at their tax details, you will see that under this scenario, they are paying $37,327 for federal taxes. This isn't state, this is only federal. And part of the reason for that high amount is they're paying $194 on self-employment tax. So that therapist is paying that simply to be self-employed. Self-employment tax is essentially what an employee pays for Medicare and Social Security. But when an employee pays that, half of it's paid by their employer. When you work for yourself, like in a private practice, you have to pay the full 15.3%. And so that's what you see in this $21,194. But there are ways to reduce that amount and still get what you need from a Social Security and Medicare perspective. And so, one thing we can do is evaluate the business structure. And so, here, what we're going to do is take a look at what happens if instead of being taxed like an LLC, we're going to be taxed like an S Corp. And so, what the S Corp does is it breaks the person out into employer and employee. So, as the owner of the firm, you're the employer. But as the person who works within the firm and creates income, you're the employee. So now you are giving yourself a salary for all the work that you do. And on that salary, you pay the entire 15.3% self employment tax that we just discussed. But as employer, you make returns for the investment in the company, and that isn't taxed with that self-employment tax. It's not even taxed as regular income. So instead of paying 33% or 24% or whatever your tax rate, you're going to pay 20% on that, and there's going to be no self-employment tax. And so as you can see, there's going to be some huge savings from that. So here, what we're going to do is include this in the plan, and there's ways to get access to this without actually changing the structure of your business. And so that's really what this is going to show. But instead of paying us all 150,000 that we made in that year, they're going to be paid 40,000 as just a distribution, basically the investment in the company. It counts as a dividend and it'll be taxed at 20% saved. So we'll save that. We have to go back and change the income that the person will receive, because instead of getting a $150,000 salary, they are now getting a $110,000 salary. Again, we're not changing anything other than kind of moving chips around here. So it doesn't impact how much money the person has access to. It doesn't impact, the way the business is structured, really, or even what they have to do. It's just a filing a form and moving around a few things, and then you'll see that from a tax perspective, it'll have a very big impact. And so we scroll down, instead of $37,000 in taxes, now they're paying $25,000 in federal taxes. That $21,000 that they owed in self-employment tax is now $15,000. And so we've already created $6,000 savings by looking at this one tax issue. There's other tax issues that we have to be aware of. When doing a full financial plan, we are also looking at the investment profile. So we're figuring out what's the most tax savvy way to invest now, but also then receive distributions down the line. Is it an IRA? Is it a Roth IRA? Is it a taxable account? How can we figure that out? And that's a big part of the analysis. So don't sleep on the tax side of the financial plan, because it's probably the one that shows the immediate money coming in, basically the immediate savings from the plan.